You are listening to Keystone Stock Talk Show, episode 226.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
We have a great show for you this week. I will start with a brief excerpt from my presentation at the Toronto Money Show this past week on current market valuations, including a bifurcation of the market and what you should focus on in your portfolio. In our Your Stock Our Take segment, Aaron answers a listener question on Pollard Banknote Limited, symbol PBL on the TSX, a leading lottery partner to more than 60 lotteries worldwide, providing high-quality instant ticket products, licensed games, in-lane ticket options, and sales-driving merchandising solutions. While the stock is up 46% year-to-date, it remains at half the price it traded at its highs in 2021. Aaron lets you know our thoughts on the current valuations and what would it have to achieve to be a recommendation. Finally, Brett answers a question on Gatekeeper Systems Inc., symbol GSI on the TSX Venture, a provider of intelligent video and data solutions designed to provide a safer transportation environment for children, passengers, and public safety personnel on multiple transportation modes. Gatekeeper is primarily a contract-driven business and is subject to significant quarterly fluctuations, but has had strong growth year-to-date after a strong Q1 and trades at a reasonable valuation. Brett digs in further and lets you know his thoughts on the stock, which is up 20% in 2023, but remains down 68% from its highs of 2021. All right, let's get to the show. I'm going to welcome my co-host, Aaron Dunn, and a sole member of the Killer Bees, Brett, with Brennan lost somewhere in the backwoods of Saskatoon, no doubt taking a selfie with a moose. That's what I think.
What
I
was
can
Brennan doing
envision
with
him
his
right
day
now.
off anyways? Does anybody know, or he was just keeping that secret?
With his family at a lake. That's what I believe, right? So there could be some moose selfies going on.
Lake country, yeah.
I could see that. See that. Well, this past week, we have to tell you, I attended 2 conferences. Aaron was at one of them, and Brennan was at one of them. The first one was a research conference in Vancouver. It was called the Planet Microcap Conference. I spoke at the event, and we also interviewed about 12 management teams. I can't speak for the companies Brennan interviewed. He can talk to you about those next week, but I interviewed Kraken Robotics, Electrovaya, which I always have a trouble saying their name, Tribe Property Technology, CCOM Satellite, Wishpond Technologies, Microbix Biosystems. So some interesting names in there, particularly the first 2. Wishpond was interesting. We know CCOM from way back, having bought them originally in the 42-cent range, sold at about in the $3 range. It trades around $1 now, pays a dividend. It's a decent company, contract-driven, like we talked about. I'm going to talk, or Brett's going to talk about a company that's contract-driven here today too as well. But it pays a dividend, it's interesting, cash-rich. But there's some companies there that were, none of them are in our coverage right now, but we're monitoring them closely.
Was interesting. I was interested to hear about Kraken because we had Kraken as a Your Stock Our Take just the week before you did the interview.
By the way, they had watched that, so there are people watching these. Definitely, yeah. They had said, "Oh, you guys did a review," and we said yes, and we're looking further. So we're going to set up a further interview with them because you only do a speed dating, you get like 25, 30 minutes there. We got to go deeper than that, but they were quite interesting, and if they can execute in the second half of this year, it's more interesting. And we attended the Money Show, Aaron. First off, I would say my comments, and then I'll get your thoughts on it. But
Sure.
It's always great to get out to Toronto. Our talk was well attended, but my general thoughts on the event was that it's not nearly overall as well attended as last year. and some other years. The show missed the mark for me on a number of fronts. I'm just going to say bluntly. First off, there wasn't a single stock picker or analyst type panel at the event. Traditionally at these, they have a number of those. A panel where an audience gets to hear from the current recommendations from top analysts in the country. There are typically some of the best attended presentations at these events in my experience. Last year, I did one with 3 other analysts. It was full room. There's likely 500 people in there. This year, like I said, not a single stock picker panel, which I think is a miss. They had one panel that I saw. It was called essentially about social investing, conducted by 20 to 30 somethings. The panelist was all these people on the panelists had great social media following. So they're probably trying to bring in their followings into that event. And these individuals on the panel, I think, had partnered they had a brokerage, essentially a brokerage concept. Now, but the problem is, I think they're speaking to a largely 50 plus audience. So it misses the mark there. I mean, that's their traditional audience. And it kind of not well attended. It is also hard as hell to get downtown Toronto at any time. So, I mean, they're fighting that as well. But I think there were some opportunities to have more people in there, and it just missed the mark on that from that respect.
Right. Yeah. And it's like the social media investing mentality, that's obviously something that's very contrary to what we would do, which is good in-depth research on individual companies. Like one of the first slides I had in my presentation was, as a piece of advice for stock investors, what you want to look for is you want to look for companies first and foremost that have assets that are in some way essential or that are solving some type of problem that society faces. Like, these are the types of businesses that you want to invest in. Now, if you can do some initial company discovery through social media, through crowdsourcing ideas, there's nothing wrong with that. But beyond that, you need to know that it's a profitable business, a real company. Most people don't do the financial analysis. I mean, it's countless times over the years I've spoken to people that have invested in companies that don't even have revenue, and they're quite surprised to hear when I tell them, that company hasn't even produced a dime of revenue, never mind profit. But when you look at social media investing as anything that's supposed to provide, the full cycle of research in terms of like, here's the idea, buy it. Your crowdsourcing ideas, it's like the blind leading the blind, really, right? Yeah. Like you just because a lot of people like something, like people will say, okay, well, it comes down to the popularity of a stock that's going to drive the share price. And in the short term, I would agree, but that's a very difficult thing to trade. Most people aren't going to be able to trade that. But for a stock,
and then you're trading relative rather than investing too. And it's
exactly.
A concept.
Yeah, but for a stock to maintain its popularity over any type of a reasonable time horizon, that there needs to be a solid foundation behind that, which is almost always going to be growth and profitability and cash flow, and being in a strong industry, a strong segment of a strong industry, and doing well there. Not just making promises to the market or having like a very fancy business model or fancy sounding business model that people like, because people will get bored. I mean, the market can be fickle. If there's not something solid supporting the growth and popularity of the stock, then that popularity is going to wane very quickly.
And I don't want it misunderstood. Like, I'm not saying don't have a panel on social investing. I think, have that panel. Like, it's great to draw in a younger crowd.
What you're saying.
Yeah. But to be the focus of an entire event that is traditionally about, good, solid recommendations and that you can profit for the long term. That can be part of the solution. It just was curious to me that they didn't have those panels, because so many people come up to us at the event and say, the reason I'm here is to get the stock picks. Like, and that's what you hear at these events. That's what many events that draw out retail investors are driven by, is the actual stock recommendations or the recommendations of an ETF or the recommendations of gold or whatever investment that you're looking at, whether it be Bitcoin, at this event. And that's why you have those panels. And it was strange to me to not see those there. And I mean, I think they had an opportunity. I'm trying not to bash on the conference, but it sounds like I am. But I mean, we had we had done a presentation in front of a large audience at this show the prior year and recommended a company called Hammond Power, which our listeners are very, very familiar with. It was trading at $16. On Friday, it was $56, basically $55. It was basically the best performing revenue producing stock on the TSX over that time. Talk about that. Say we're going to then have our next stock picks at this event and draw out a lot of people. There's other conferences that we go to. They do that. I just, I'm venting that today because I think you missed the mark. I'd love to fly out there and talk to more people, but the event just wasn't as well attended as we typically see. And I think it's because they didn't have those panels from my perspective. But we did note, Aaron and me walked around the event on a lighter note that we saw Canada's youngest retiree there. Brett, you got a picture that you can put up for us, right?
Yeah.
A gentleman had a booth there, and in tongue in cheek, myself and Aaron saw. I think this book was written around 20 years ago, and we looked at the gentleman who had the sign up, Canada's youngest retiree, and myself and Aaron consider ourselves old half the time, and he was older than us.
Yeah, I mean, I was thinking like times must be rough.
Yeah, I know.
His youngest retiree is older than
75. I'm kidding. He didn't look 75. He looked great for his age. He's probably, 50, 53 in that range, probably, right? But anyways, what came to mind to me is you need to retire that slogan. So, and we're not, honestly, we took a look into his book, and there was some good common sense advice in that book. So we're not hammering on the book or anything. There really was some good common sense advice in there. It's just a funny image. When I was walking through and looking at this, there was like BMO's booth or Royal Bank's booth, and then Canada's youngest retiree, and it was it just didn't.
Yeah,
got to retire that.
As an example, I don't call myself the youngest anything anymore. So.
Yeah, that's true.
The youngest guy in the long-term care home, maybe, right?
Yeah, it's true. And we shouldn't make fun of anything. We found it funny.
Just good lighthearted.
Yeah, we hope so. Yeah. We'll probably get ripped now because of that. Anyways, do any other comments on the show, Aaron? Or
I mean, not much. I mean, one thing that happened last week was on Wednesday, the Bank of Canada made the decision to hold interest rates steady. So that was expected. They did not increase rates as they did in the meeting before. And there have been signs of sluggishness in the Canadian economy. So that's leading people to think that maybe now the Bank of Canada is finished with their rate increases. If that is the case, obviously depending how the economy trends. But if they are finished and we are going to see maybe over the next year to 18 months, rates actually start to go lower than where they are right now, start to decrease. That will certainly be, a positive for some industries. One of the questions I've gotten in the past is there are, several of the more stable, higher yield, large cap dividend growth companies that have really kind of, had lackluster performance over the last year or kind of traded in a range. People have asked, what is the catalyst to basically break these things out? A lot of the times the financial performance has been good. It's really just the stock market performance that's been, a little bit disappointing or lackluster. Well, one of the things is once we start to see rates come down even a little bit, or the mentality is that rates are going to start trending down, that would certainly be a catalyst for some of these large cap dividend companies. Right now you can get 5% plus, maybe even 6% now on a GIC. So certainly compared to where fixed income was a couple of years ago, much more competitive against dividend stocks. The difference, of course, and I've talked about this before as well, is that one of the big differences between a dividend growth stock and a fixed income product like a GIC is that the dividends for dividend growth stock, there's potential that those dividends, those income streams are going to continuously increase over time every year. That is not the case with a fixed income product. It will eventually mature. You will have to, if you want to go into another fixed income product, you may be getting a higher coupon rate or a lower coupon rate. Just depends where interest rates are at the time. So But it'll be interesting to see over the next couple of quarters here how things go with the Bank of Canada's decision.
And how the increase in the dividend can be powerful for you as an individual or any investor over time is, like, I'll give you an example. When we originally bought Dynacor, the yield was in the range of 3.5%, 3%. But they've upped their dividend like 4 times since then. And the effective yield bought at that price is in the range of 8% now.
Yeah.
The stock has gone up too. So, and if that continues, like if 10 years from now, every year they're increasing their dividend, you can get effective yields of 15 to 20% on stocks that you bought, or higher. And it's a tremendously powerful way to create capital over the long term and compound that. But it's a great way to do it. And I don't think investors take that into account all the time. They just,
it's seen as a more boring way to invest, right? Like what's exciting now is like the social media investing, right? Like the meme stocks or crypto, or when it's fashionable, when it's popular. But another one of the companies that I covered at the Money Show is Brookfield Infrastructure, which is a long-standing recommendation. We recommended it in 2011, and I illustrated that over that period of time, about 12 years, we recommended it at an effective price of about $9.60. And it's paid out income distributions of about $15 over that period of time. Plus the price, the stock price has gone up to about $43, $44. You still have a growth oriented company where that income distribution is essentially growing every year, right? So, it's not something where it's really exciting over the next 6 months necessarily to invest in these dividend growth stocks. But if you have a reasonable time horizon going out multiple years, I mean, there's a lot of torque on that type of a strategy as well, if you pick the right companies, of course.
For sure. All right. Well, I'm going to do a quick excerpt from unless anybody else had anything else to say, we're good. I'm going to do the excerpt. All right. So as part of our presentation, I looked at the rally in North American markets, starting with the S&P 500 and NASDAQ indexes after both were sharply lower in 2026. You can see there the S&P 500 down 19.3%, recovered year to date up 16.9%. Similar, the NASDAQ down 33% in 2022, started with a bang. The recovery has been more pronounced on the NASDAQ, where it was more pronounced in terms of a downturn over the 2022. And in 2022, that was really a historic decline. As we can see on the chart here, however, the tech-driven exchange has rebounded year to date, up now 33.8%. Again, not clawing back all of the losses, but a significant percentage. But it is a tale of two markets. The gains in 2023 have been driven largely by 8 stocks known as the Mega Cap 8: Alphabet, Amazon, Apple, Meta, Microsoft, Netflix, NVIDIA, and Tesla. They alone account now for over 26% of the S&P 500 and roughly 50% of its year-to-date returns. 8 stocks powering the total return of the 500 stocks in the S&P 500. The remainder of the index and the smaller cap companies in particular have not fared nearly as well. So let's look here at the broader valuations first before I get into that and a potential opportunity. Now, broadly, one metric we like to use or look at when we look at the broader markets is the Shiller PE. It is a more reasonable market valuation indicator than the regular PE ratio because it eliminates fluctuations of the ratio caused by variations of profit margins during business cycles. Now, here's the Shiller PE over the last 20 years. It reached its highest point right here, November 2021, in the range of 38.6. That would be 47% higher above the average PE of the last 20 years, which was 26.2. The highest ratio that it has reached in the past, that was the highest ratio it's reached in the past 20 years. Now, this is looking back over about 100 plus years. The highest point, that point was only exceeded once, and that is in the dot-com madness right there in 1999 at roughly 44. Now, where are we today? That should be the next question here. Well, valuations today, we look at the Shiller PE, it's roughly 31.1. That's 18.7% higher than that 20-year average I talked about, which was 26.2. And that is far better Then the range of 38, it was hit in November of 2023, sorry, which was 47% above the PE of the last 20 years, the average PE of the last 27 years, or 20 years, sorry. However, it is instructive to point out that the Shiller PE is still 79% above its all-time average. Its all-time average is 17.4. That indicates we are not historically cheap, or hysterically cheap either, but mainly historically cheap. It's better than the peak, but the market remains bifurcated. As far as the forward-looking regular PE on the markets to transition to where we are on a forward-looking basis today, it is a tale of two markets in terms of valuations. Now, this is a simple chart. Well, kind of looks simple. Kind of looks like a plate of rainbow spaghetti to me, but it shows the disparity between the large and mega cap stocks represented on the red and purple lines, respectively, and between the small cap universe. That's represented by the green line here, and that is following the S&P 600 small cap index. Now, I'm going to just give you the broader forward-looking PEs on these three indexes. S&P 500 large cap is at 18.5. The mega cap 8 is 28.1. The S&P 600 small cap is 13.8. So larger caps and the mega cap 8 are trading at significantly higher multiples than the S&P small cap 600. To give you an idea of the constituents of the S&P small cap 600, to be included in this index, a stock must have a total market cap of ranging between 850 million to 5.2 billion. So that tells you what is considered essentially a small cap stock in the US via this index. Drilling down on small caps versus large cap story, the valuations here, this is since 2005, the S&P 600 has historically traded at a premium to their larger cap S&P 500 counterparts. But we can see today, small caps trade at a significant discount to their large cap peers. Again, this chart highlights the discount here. It's pronounced and likely presents a long-term opportunity if you're looking at quality, growth-oriented small caps. So the question is, what should you do today? One thing you can do is just focus on what you can control in your portfolio. That would be number one, the construction of portfolio. This is how to build your portfolio, how many stocks you own, over what period to build it, and when to adjust and review your portfolio. Well, you can get that advice by coming to one of our live webinars on demand. Find them at www.keystocks.com. We'll show you the simple steps of how to build a 15 to 25 stock portfolio. And I talked about that briefly in the presentation at the Money Show. But number two is also just the composition of your portfolio. What type of stocks you want to own in that portfolio. Those are the things that you need to focus on right now. Now, I'll tell you what we're avoiding in the market. We just looked at over 3,000 companies in the US and what we're avoiding when we look at these companies. Near term, I would not recommend buying the index given the valuations, but fortunately is not a market of stocks. It's a stock market. There are still select companies that are growing that look attractive. Now I can go into what we're looking for and what we'd avoid today here. What we'd avoid is, or what we'd really look at is to pay attention to the balance sheet, particularly cyclicals with heavy debt. This is where you can really get into trouble in a highly leveraged company. Interest payments have gone higher and they're eating into profitability. So companies like restaurants, hotel chains, airlines, furniture, high-end clothing retailers, automotive manufacturers, these type of cyclicals, look at the balance sheets closely when you're looking into those businesses. Now, this doesn't mean that strong cash flow producing businesses with debt, you should eschew completely right now. They are fine if they're producing strong cash flow, but we are favoring cash-rich businesses. These are stocks with a net cash balance on their balance sheet and they're producing strong cash. Yes, we want them to be able to weather a downturn, but that's not the sole reason we look at them. We want them to be able to profit from it, make acquisitions in times when they see other businesses on sale. Now, an example of this I'll give you from our research, and I talked about them at the event, would be Dynacor. It's about 33% of its market cap in cash, zero debt, and a profitable business. Another example I can give you is a company we've talked about a number of times now is Hammond Power Solutions, HPS.A on the TSX. Huge cash flow in 2022. It went from a net debt to net cash positions. It can expand now organically and through acquisition. Now, what is Hammond Power? Well, they are a leader in the design and manufacture of custom electrical, engineered magnetic, standard electric, dry type, cast resin, and liquid filled transformers. Those are not Autobots and Decepticons, although that would be seriously cool. The transformers that Hammond Power makes are used to step up and step down travel for it to step up over a long distance and then step it down for an application such as to bring it into your home or a charging station. In fact, every Tesla charging station in Canada has a Hammond Power transformer. For years, we have seen it as a backdoor way to play the electrification boom. When we recommended it several years ago, it traded in the $7 to $8 range, and that was a re-recommendation. It was trading around 7 to 8 times earnings. That is real earnings, not an adjusted basis, versus the many obvious electric vehicle or EV plays like charging station companies and EV manufacturers that then traded at ridiculous valuations if they even had underlying cash flow. Now, Hammond Power had decent growth in its core business, but as the world electrified, our thought was the growth could increase. Now, that has followed, particularly over the last 18 months, and the stock has followed. It still trades at 11.5 to 12 times this year's expected EPS. Hammond is a good example of one of the type of unique opportunities we scour the markets to uncover for our clients on a daily basis. With the smaller, growth-oriented business currently trading at relatively attractive historical valuations, there may be some longer-term opportunities presenting themselves to find the next Hammond Power and help you produce outstretched returns over the next decade. And that's what we try to do on a daily basis for our clients in their portfolios. So hopefully that makes sense. That's a snippet from what we talked about at the Money Show. Any comments on that?
No, I find it interesting how, on one hand, the market overall is so much more expensive than it was historically on a historical comparison, yet small caps actually are not. At least not to the extent. And if you go back 10 years, are actually, at average to below average levels of valuation.
Yeah. And then it's flipped. There was a premium for, well over a decade and beyond that in the teams of, and especially in quality oriented, growth oriented small caps in that range. Like, we're not talking about a $50 million market cap on the TSX Venture as a small cap. You're talking about 800 plus million up to the 5.8, I think it was, billion dollar market cap. So, many of those are high quality businesses, growth oriented, just considered smaller cap companies in the US market. Those, because of the fact that they're, have the ability to grow at a better rate historically than, say, a company with a 500 or $1 billion or $500 billion market cap. It's easier to grow a business when you have smaller numbers. Now, they traded at a premium. It's flipped. They're trading at a discount today. A lot of that is powered by the, massive multiples you're seeing on some of the mega cap 8. But, overall, the small caps, even removing those mega cap 8, they are trading at higher valuations than the large caps are trading at higher valuations than the small caps. So it could be an interesting time. That doesn't mean, you rush out and load your portfolio with small caps today, and you shouldn't do that at any time. It can be a balanced part of an overall portfolio, and that's what we recommend to our clients. And again, it's got to be cash producing businesses, good balance sheets, good growth ahead of them. But having some of those in your portfolio will likely be a benefit to you over the next 10 years. All right, let's move to the next segment here. I think Aaron's going to handle that, and you answering a question on Pollard Banknote, which is an interesting company, but had a good start to this year. But again, it's still down significantly from its highs. I mean, you see many charts like that, particularly smaller mid-cap companies that got into some silly season in 2021 and, have seen their share price cut in half from there. But a good start to this year in terms of where the share price has gone. Is it justified? Aaron's going to let you know.
Absolutely. So Pollard is a company. We're very familiar with the company. We've been following it for many years, 5 to 10 years actually. So one of the reasons why we've been following it is because I just think it's an interesting business. What they do is Pollard is a leading lottery partner for over 60 global lotteries, and what they do is they print lottery tickets, physical tickets, including pull tab tickets, bingo paper. They provide vending machines. They also provide a number of digital services in support of lottery operations, and this would include game apps, iLottery solutions, and others as well. So really, it's a lottery service company, and lottos are generally considered to be a defensive industry. It's not something that is necessarily very economically sensitive. So we like that about the business. We like that it's been a profitable company. Just to go through some of the data here, symbol is PBL. It trades on the TSX, Toronto Stock Exchange, trades at a price of about $26.50, 713 million market cap, 27 million shares outstanding. Now, one thing that's really important to note about Pollard is that it was originally founded in 1907, and it is still controlled by the founding family. So 64.2% of the company's shares are controlled by the Pollard family, and the other 35.8% by public shareholders. So this is an interesting thing to talk about, because generally we would say that a high amount of insider ownership, especially by the founder or the founding family, is a good idea because it aligns those owners with the shareholders. Now, in this case, I would actually argue that 64% might actually be too high. And my logic here is just that when the founding family owns such a commanding percentage of the outstanding shares, it really almost kind of becomes a family business. And I would even question why, unless they have to raise a lot of capital, which Pollard doesn't, why they would even be public. Now, I think that they've done a fairly good job of running the company. There's no complaints that I have there. But you could certainly be in situations where there are decisions that might work well for the family that don't necessarily work well for the shareholders. So I don't have any issues specifically about their stewardship of the company. It's profitable business. They haven't gone out there and made foolish decisions with the capital structure, which we would not expect them to do, given that they own a lot of the company. One thing, Pollard pays a very small dividend, almost insignificant. So maybe if it were, more focused on the public market shareholders, that would be, they'd pay a more meaningful dividend. But I would just say that, this is a company that is completely controlled by the founding family, and there are good things about that. There are also risks. But anyways, let's get into the actual company here. Take a look at where the stock has been over the last 12 months. They've had a pretty good run in the market, starting the 12-month period at about $20 and up to $26.50 right now. So good return over the last 12 months. Now, if I were to pull up a 5-year chart, we can see that there's actually been a considerable amount of volatility. Company had a very good run after the pandemic started, actually, like many companies. And then since then has had a big drop in the share price. Recently, the stock price coming back up and showing some signs of strength, but huge amount of volatility, and really the stock not going anywhere meaningfully in terms of return, annual average return over the last 5 years. But last year has been good for the company, for shareholders, the last 12 months. So let's take a look at the financial results and see if we can identify some reasons why. Now, the Q2 results at face value look very impressive. Sales of $130 million up from $115 million. That's 12% growth. Adjusted EBITDA of $22 million up from about $19 million. So it's 17% growth. And then earnings per share, 27 cents up from 9 in the same period last year. That's 200% growth. So the first thing that I'm looking at here is, why is adjusted EBITDA growing 17%, whereas earnings per share are growing 200%? Now, adjusted EBITDA is going to represent the operational profitability of the company, whereas earnings per share is going to represent both the operational and financial profitability. So what I mean by that is that earnings per share this is the very bottom line. So it's not just the profitability from operations, but you're also including financing expenses and income as well. So that's interest expense, interest income in some cases. You're including tax in there. Things that are outside of what we consider to be the operations of the company, but still very impactful to the common shareholders. So really what we want to do here when we see such a discrepancy between the operational profitability and the net profitability is we want to dig a little bit deeper and identify where the gives and takes are during the quarter. So this is going to be a bit of a financial analysis of the company. That's what we're mostly going to focus on in this Your Stock, Our Take segment, but for good reason. So why don't we just start off with I pulled up a snapshot here of the quarterly income statement. So first thing we're going to do, we're going to start off at the very top line. That's the sales. As I said, 130 million up from 115. So, a little bit less than 15 million in additional sales for the quarter. But the problem here is that right when we look here at the gross profit line, 20.14 million compared to 20.89 million last year. So in spite of 15 million in higher revenue, they actually generated less gross profit. So gross profit is essentially the sales less the expenses that are directly related to the sales, or the cost of goods sold, as they're otherwise mentioned, as otherwise referred to. So right away, as we're seeing that what we can get from this is that the increase in sales did not contribute to the increase in profitability, because gross profit was actually lower in the most recent quarter. And we're going to go further down the income statement here. So administration expenses also higher by about 2 million. Selling expenses also higher by about 800,000. So operating expenses were higher. Then we go to the next line here. We see equity investment income, 9.2 million compared to about 5.1 million last year. This is a gain. This is not an expense. This is a gain that gets added to the net income. So there's about a $4.1 to $4.2 million difference here, additional gain on this line, equity investment income. So this is what I would say is the major contributor to the earnings growth over the period, right? We're going to continue to go down. We see operating income from operations, 9.87 compared to 8.72. So about 1.1 million higher. Then we're going to go down to finance costs. So this is essentially interest expense, 2.7 million compared to 4.7. Okay, so they saved about 2 million in interest expense. Then a line lower, finance income. So this is essentially the interest that they're receiving on any cash deposits, 1.7. So that's an additional 1.7 million that we're adding to the net income. And then finally, we'll look at the income taxes here. Total income taxes, 1.28 million compared to 1.52. So in spite of higher income from operations, there was lower income taxes. So what am I getting with all of this? Well, where I'm getting is there is a huge increase in earnings per share, net income. So net income for the period was 7.54 million compared to 2.46 million. So you're looking at about a little more than $5 million difference. 5 million was added to net income. And we need to figure out, well, where did this come from? And where essentially we figured out it came from is the equity investment income, the lower interest expense, the higher interest income, and then the lower income tax. It did not come from the increase in sales. It did not come from the operations of the business, right? So this is very important, because when we're trying to get a sense of what growth is going to be like going forward, we can't rely on higher finance income or necessarily lower income taxes. Like, these are not sustainable drivers of growth. And looking at a line item like equity investment income, well, I don't really know what that is. It's something that's not going through the sales line. So that's something you would need to look deeper into. What we want to see is that this growth came from the higher sales, ideally stable or higher gross profit margins. And then we basically take it from there. So this is a concern in terms of where this huge growth in net income came from. One thing I will do is I will look at the cash flow statement here. When we look at the equity investment income, one of the things I want to know is is this a cash inflow to the company, right? So it's positively impacting net income, but is it actually generating cash? Because that's how you assess earnings quality is, are these net earnings actually translating into cash flow? Well, in this case, it is not. Investment equity income for the 6-month period was 17.8 million. None of that was cash. That was not a cash inflow. That was just an accounting item, right? And the net income for that period was 12.3. So this is a major influencer, this line item, equity investment income, of the profitability. And it was actually higher for the 6-month period than the entire net income. So this is something we have to pay attention to. This makes the financial reporting much more complicated. Now, I will note the cash conversion to earnings actually does still seem to be pretty good. You have 33.8 million in operating cash flow compared to 12 million in earnings. Now, there were non-cash working capital, which will fluctuate from year to year. So, we take that out, and what are we left with? Roughly about, I would say, 17 million in operating cash flow, still higher than the net income reported, largely due to the depreciation and amortization that gets added back in, because that's a non-cash expense, but there is still a real expense associated with that. But very interested to learn about this equity investment income line item. So we can go to note 6 of the financial statements to figure out what this is. There's 2 entries here in note 6. One is NeoPollard Interactive LLC. Pollard, in conjunction with Neo Games, operates NPI. The entity was established to provide iLottery services in Canada and also Michigan iLottery. Pollard and Neo Games operate the iLottery operation for the Michigan Lottery under a separate joint venture agreement. So essentially what this is Pollard has a joint venture with another company on assets, and they recognize the earnings from these assets, even though they are not generally a cash inflow to the company. Now, is this necessarily a horrible thing? Not necessarily. I would need to learn more about it, but absolutely we can see in the cash flow statement that it is not a cash inflow from the company. So you have to be very careful about how you treat this line item, because it's adding to earnings. It's making the earnings look good. It's not contributing to the cash flow. So we'll just go on to the balance sheet here. Balance sheet looks okay. I would say still fully leveraged, about 150 million in debt, 260 million in equity. So debt to equity looks fine. But net debt to EBITDA 2.9 times. I don't think that is over leveraged. I also don't think that it's under leveraged. I will just say that it's fully leveraged. And then we'll just look at valuation. So I'm just going to take the full earnings that are on the income statement. I'm not even going to take out those non-cash earnings from the joint venture. That would be about 90 cents in earnings per share over the last 12 months at the current share price of $26.50. That's about 30 times earnings. Certainly not cheap. Given that this is a smaller, thinly traded company with complexities in its financial reporting, I definitely do not believe that 30 times earnings is a cheap multiple. So what is our take on Pollard? I do think it's a unique business. I like where it's positioned. It's been around for a long time. I don't think it's going anywhere. It's in a defensive industry. It does have a history of profitability and a history of revenue growth. However, a lot of this recent growth that we've seen has been generated from non-operational sources. The financial reporting is complex. You'd really need to dig deeper into it. Fully leveraged balance sheet, and I would say a moderately high valuation. So what would we want to see from the company that would encourage us to maybe pick it up as a recommendation? I would say, focusing on that consistent growth in consistent growth from operations. And then also I'd want to be able to buy it at a more attractive valuation.
Yeah, and you looked at the balance sheet, not necessarily completely over levered, but we wouldn't expect a significant juiced up acquisition like at this point, unless they issue equity.
Comparing that, if the balance sheet said, they had 100 million in cash and no debt, then we would be looking at this. It's like, they've got a treasure trove of capital.
Yeah.
That they can then go out and they can use to buy another asset and grow the business that way. So this is why we look at the balance sheet. It's also, I mean, if I were looking at this and it was a net debt to EBITDA 5 times or 6 times, I'd say you don't even consider it because this thing is so leveraged with debt. That makes it quite high risk. So it's just it's at that point where, I mean, where would I want to see the leverage? Probably between 2 to 3 times. So maybe average that out to 2.5. It's 2.9. It's not horrible. It's not necessarily great. It's just what I would consider fully leveraged.
Yeah. Okay. All right. That's a really good summary. Let's move on to Gatekeeper Systems Inc., GSI on the TSX Venture. Brett?
Yeah, you got that right. Yeah. It's actually interesting that we're doing this one because we're doing our CDR sweep right now, which we go through all TSX and TSX Venture listed companies. So the NEO is the few that are in there. And I came across this last week, and then we got our...
yeah, that's interesting that somebody reached out at the same time, that it just pulled up on your list, and you got it. So, yeah, who better to look at it then, right?
Exactly. Yeah, no, it's a good question. It's an interesting company. All right, but I'll get into it. So Gatekeeper Systems, symbol GSI on the TSX Venture, is a leading provider of intelligent video and data solutions designed to provide safer transportation environment for children, passengers, and public safety personnel on multiple transportation modes. The company breaks its operations into 2 segments, school and transportation. And it serves both Canadian and US markets, with the lion's share being from the US market. The company currently serves about 3,500 customer school districts across every state and province in US and Canada. The stock is currently trading at about 34 cents a share, rising 20% year to date. Gatekeeper defines its revenue model as Platform as a Service, or PaaS, not SaaS, PaaS, which sells its services including on-vehicle recording, GPS, video analytics, transit lane enforcement, passenger counting, mobile Wi-Fi, thermal cameras, AI dashcam, and much more as a package service on a recurring contract basis after initial setup. Like a SaaS model, you do see recurring revenue, but the company also has a bit more lumpiness because it has contracts when they're first initiated. They have the setup fees, they have hardware installed, and stuff like that. So, moving to the income statement. During fiscal Q3 2023, ending May 31st, Gatekeeper had revenue of $5.9 million, up 35% compared to the prior year, but down sequentially from the prior quarter's record revenue of $9.7 million. The large fluctuation in revenue on a quarterly basis is due to contract revenue recognition, as they had a large contract in the previous quarter. However, that is not to say the company isn't growing. The year-to-date, so 9 months, revenue was up 101% to $20.5 million. As well, notably, the gross margin for the company for the last quarter, so Q3, increased to 50% compared to 41% in the prior year, whereas the 9 months has been flat at 44%. The company has flipped into profitability, which is always great to see over the past year, with Q3 having a net income of $440,000 versus a loss of $318,000 in the prior year, with year-to-date having a net income of $2.2 million versus a loss of $800,000. As well, it is worth noting that the company is now paying taxes, which it previously in its profitable quarters was not. So going forward, you can expect taxes assuming they stay profitable. Gatekeeper was previously profitable prior to COVID-19, but saw significant revenue shrinkage and in turn then EPS turning negative as well. And in this graph, you can see it just fluctuates quite a lot on a quarterly basis. Earnings just have not been consistent so far. I will note as well that the share count only increased by from 87.6 million at the end of 2019 to 91.5 million, which is about a 4.5% increase, which isn't a massive drag on the share count like we saw some small cap companies to survive through the pandemic. They just diluted. So it is nice to see that, given they had a very material impact due to COVID, that it didn't just dilute its shares into oblivion. Additionally, the company has been able to flip into operating cash flow being positive of $563,000 for the last 9 months compared to a deficit of $3.6 million. And this is with increased working capital levels over the past 9 months. Gatekeeper has been able to lower its line of credit to only $1.6 million from $3.5 million, which is good to see given it is a variable debt at this time. It is a line of credit, so it's based off prime for whatever currency they're borrowing and plus percentage. And so we're in a high interest rate environment over the past year compared to what we were 1 or 2 years ago. It would have been a much higher interest rate expense. As well, net debt, including leases, fell to 1.5 million from 1.9 million, offset by a decrease in cash, of course, compared to their debt. Leverage is not really a concern at this time. If the company is able to stay profitable, it's only like a 0.3, 0.4 net debt to EBITDA, so it's very low. Looking at valuations, Gatekeeper trades at a trailing price sale of only 1 time and a trailing price earnings 7 times. And if you normalize the past 12 months for taxation, which it will, assuming it stays profitable, it will have taxes going forward. It will be about 8 to 9 times, depending on the exact tax rate they realize. So the valuation is quite cheap given the recent growth on the top and the bottom line. However, it will be a touch higher if all else equal there is taxation. So our take. The company is returning positive earnings, which is great to see, especially the last quarter having no major contract disclosures. So we see it's more coming from that recurring revenue versus you have one big contract in the next 12 months. You have nothing. It's good to see that they're actually being able to maintain a positive bottom line when it is just that recurring revenue for the most part. The balance sheet is minimally leveraged at this time and it's recently paid down over half, which is also good to see. Moving forward, however, we would like to see sustained net income. We don't want to see those big fluctuations quarter over quarter back down negative. They were negative at the first quarter, slight negative, I should say. And previously we saw with COVID, they crash way back down for sales and for earnings. We really need to see that sustainable to be investable, but it is on its right track. It's been diversifying between regions, expanding its operation locations, winning some big contracts, which are good going forward. But we need to see them just keep doing more of that so they can gain those sustainable earnings. So I'll open up to you guys if you had any comments.
Yeah, I mean,
one thing that I'll just say, one thing that I noted is, about 500 million, or sorry, 500 million. What was it? About 2.1 million in earnings for the 6-month period, but then cash flow of only 500,000. So that's, what we would want to see, generally speaking, is that the cash flow is significantly higher than the reported net earnings in order to say that there is high earnings quality. Now, if it's 1 quarter, even 2 quarters, the cash flow can fluctuate, but that's something that you want to keep an eye on. And if it's consistently below the net income over a period of time, then we would say it's low earnings quality.
Yeah, I mean, I think I said that Q1 in the intro was a big quarter for them this year. I think it was Q2 actually that was the biggest quarter for them. Yeah, they are. I mean, if you just look at the last 4 quarters in terms of volatility of the company, revenues in Q4 to end out last year, 9.8 million. So very strong quarter, 2.4 million in operating income. Then the next quarter, 4.9 million in revenues, lost 500,000 operational basis. Revenues in Q2 were 9.7 million. So tremendous profitability, operating basis, 2.2 million. And then if you look at revenues in the last quarter, Q3, 5.9 million and just 500,000 in profit. They stayed at a net profit, or at an operating profit, but wide fluctuation just in the past 4 quarters. And so on a trailing basis, I think those 2 quarters, the Q4 and Q2, were the best in history of the company, essentially. So yes, it makes for a low PE. Are they going to be able to do that going forward is the question with the lumpiness. So and perhaps backlog is something to really track closely if they're publishing that. And to see if that is increasing over time, because then you'd have some confidence if they can maintain a reasonable margin that, over a 12-month period, you're going to execute on that backlog. And then rolling forward, if the backlog could continue to increase, that's what you'd like to see. I mean, often when you're dealing with a company that is contract driven, it is something to look at to give you confidence that at some point you may have 1 poor quarter, but it may smooth out over a year. And a backlog can give you some confidence that that's going to happen. If you're flying in the dark from quarter to quarter, it's very difficult, in a contract-driven business for sure. So, I mean, Gatekeeper's interesting for sure, particularly based on the trailing valuations. I'm not sure did you track, was there a backlog that you saw there? Did they publish something like that?
Specific backlog.
Yeah. So that would be something we'd ask. Some industries, it's far easier to do. Some companies are more willing to put it out. Some aren't, right? So, it'd be something that we'd want to look at because of the fluctuative nature on a quarterly basis, at least. And if you could continue to see an uptick in that over time, then it might give you confidence to buy it and not look just quarter to quarter on it, look more on an annual basis, what they could produce. So it's interesting. We'll probably reach out to them again at some point going forward. All right. I think that's going to close out the show. Any shots at Brennan before he's not here? I mean, most of the shots are when he's here. So,
what do you mean? He's right there with his moose.
Yeah, I did. I hope he's got the selfie. He better show us him and that moose. He'll probably be trampled by one and never found again. But we hope he's back next week. And we encourage you to keep your questions coming into our Your Stock, Our Take segments. If you're watching us on YouTube, smash that subscribe button. If you're listening to us on iTunes, rate and review us. Only 5-star reviews, of course. And I'd like to wish everybody profitable investing. Thank you.
Great. Thank you. See you next week.
Thanks, everyone.